Hi guys, welcome back to the Financial Interest YouTube channel. My name's Dan. So we've just passed the halfway point in 2022, and obviously we've seen a lot of the indexes in the US and around the world have gone down quite a lot in that time. So I thought what would be interesting is to look at the top 5 in terms of the worst performing stocks so far in 2022. So let's get on with the video. So just a note before I start, these will just be the worst performing stocks in terms of the drop of their stock price so far this year in the first 2 quarters. They're not necessarily going to be the worst performing stocks in terms of things I would normally look at, such as the net income, free cash flow, and return on invested capital. They're simply the stocks that have dropped the most in terms of their price. So coming in at number 5 is Bath & Body Works, and the company's seen a stock price drop of 61.43% in the first 6 months of 2022. This is an American-owned retail store who specialises in soaps, lotions, fragrances and candles. And whilst they had a great boost to their business at the beginning of the pandemic with the extra sales of sanitizers and things like that, the kind of growth has now caught up with them with inflationary pressures going on in the general market. So now they're seeing higher costs to produce their goods. So they recently revised their guidance down, which is one of the main reasons that a lot of investors have started to jump out of the stock. Originally, the management team thought the impact of the inflation was going to be around 225 to 250 million this year. And along with the fact that they're spending money on upgrading their loyalty scheme, this is actually going to kind of hurt their profits quite a lot in the short term. And coming in at number 4 is PayPal, and their stock is down 62.97%. So as you can imagine, the online payment giant saw their profits jump quite a lot at the beginning of the pandemic when everyone was turning to e-commerce and needed to pay for transactions for all the things that they were buying. And of course now with rising inflation, we've seen consumer spending go down, and obviously as a result this cuts down on the number of online payments and transactions being made as well. So you kind of just need to think about it that they just brought their growth forward. So they could have ended up in the same place now, but it's just they grew quite a lot in the beginning of 2020. There's still reasons to be optimistic with PayPal despite this, because one of the companies they own, Venmo, has recently signed a deal with Amazon. So they're going to be one of the main payment providers for US transactions there. And this should help really boost PayPal's presence in the e-commerce space even further after they broke away from eBay. And the management team also came out and changed their guidance as well recently, saying that they're only expecting revenue growth of 15 to 17% rather than the 18% expected by analysts. And coming in at number 3 is Align Technology, and their stock is actually down 63.99% as of the first 2 quarters. And you'll probably know this company for their main product, which is Invisalign, which is the clear aligners for teeth, but they also have a number of different products and services which they sell to orthodontists and general dentists. They've seen declines in their net income and operating income in the first few quarters, which has kind of left investors kind of a bit scared that the future might be getting a little tricky for this company. And whilst they're still in a really strong position within this market, their patent for the clear aligners actually ran out in 2017, and since then they've been facing stiff competition from other providers. And the inflation has also seen pricing pressures as well. And this could be considered one of the more kind of luxury items. It might not be physically required to actually get the teeth fixed or anything like that, but it might just be more of an aesthetic thing, which of course you would pay for when you have more money, but when money is tight you might put off that for another date further down the line. Coming in at number 2, we've got Etsy, who is down 66.56%. So this is an online marketplace for buying and selling crafts. And they saw the same thing because it's based on e-commerce, so they got a huge boost to their business during the lockdowns. Obviously people had more money to spend. They were doing a lot of business with homemade craft masks. And once again, since inflation has started to rise, that's also caused the kind of growth of the platform to slow down a little bit as consumers are cutting their spending now. And also the platform historically has always been quite focused on women, but now they're trying to kind of look more to the male market as well to kind of grow into that particular area. So they've still got quite a big total addressable market and kind of runway for growth ahead. And finally, number 1 is Netflix, who is down 70.97% in the first 2 quarters of the year. During the beginning of the pandemic, Netflix saw a huge growth in the number of subscribers, which obviously isn't really surprising because a lot of people are at home and they don't really have much to do, so they decided to spend on streaming services. But what Netflix mentioned is this is simply bringing their future growth forward, and everything kind of seemed like it was going okay until we got to the first quarter results. They saw a loss in subscribers for the first time in 10 years, and obviously at this point a lot of investors jumped out of the stock, and this was made even worse by the fact that they said they expect to lose more subscribers throughout the rest of the year as well. So this really caused a lot of the institutional investors to bail out of the stock, and I made a video on this a couple of months ago, so I'll leave a link in the description as well for that, so you can go and check it out. So there we've seen the worst performing stocks in terms of the stock price for this year so far. But one thing that's worth remembering is the main institutional investors, they're really looking for results now, so they're not going to be prepared to sit back and watch a company lose money or lose subscribers over the next few quarters. They have a really short time horizon in comparison to individual investors. We can look at a company and say, okay, this is going to take a few years to fix, but we have a long-term time horizon of 10 years or more, so it doesn't really matter to us. We know the business is going to improve in the future and get back to what it was. We have the patience to sit and wait for that to happen. And looking at some of these companies that are the worst performing stocks, they're actually decent companies if you looked into the fundamentals. I mean, Netflix, obviously, they still spend a huge amount on generating content to build the brand out and to continue to pump money into that. You look at companies like PayPal, they're a very well established company, and also Etsy has a long runway for growth, so I'd expect these companies to be better in the future. It's just that they're taking a short-term hit for that. And we need to remember that we always need to look into the moat of the company, the management team, and also just really check our valuations and make sure that they kind of align with the growth we expect for the future. And I'll leave a link as well to my valuations playlist if you want to check that out. So that's it for the video. I hope you enjoyed it. If you did, please give us a like. Also consider subscribing to the channel as well to get notifications of when I'm releasing new videos. And let me know in the comments below what you think the future is going to be for these companies we've just seen here. So thanks for watching, and I'll see you in the next video. Cheers.